Hello, people. Welcome back. In this session, we will talk about the EV to EBITDA multiple. Again, it's a part of our valuation series in which we are trying to cover various valuation multiples from a practical perspective. We have already tried to cover the price to earning multiple, the price earning growth multiple, the price to book value multiple, as well as the price to free cash flow multiple. If you want to understand those multiples in detail, please refer my previous videos. But in this session, we're going to discuss about the EV to EBITDA multiple. Again, a very important multiple used for different types of industries. So again, if I just try to decode the multiple in the most simplest sense. So first of all, we need to understand both the parameters of this multiple. So one is the numerator, that is the EV, and the second parameter is the denominator, which is EBITDA. So here, if I talk about EV, so EV basically stands for the enterprise value. EV basically stands for the enterprise value. And here we need to understand that what exactly is the enterprise value. And we also need to differentiate the enterprise value with the market value. As many of us tend to get confused between this fact of what exactly is the difference between the enterprise value and the market value. So here is ideally the difference. So for example, if I just talk about the market value, if I just talk about the market value, the market value is simply your equity value. The market value is simply your equity value. And how is the market value calculated? The market value is simply calculated as the number of shares into price. The number of shares into price is the market value. So hence the market value is just taking into account the total number of equity shares only into price, just from an equity perspective or a preference shares perspective. So the market value, it takes into account both the equity shares as well as the preference shares. But if we talk about the enterprise value, if we talk about the enterprise value, it takes into account the market value of the equity plus the market value of the debt, the market value of the equity plus the market value of the debt. And here the debt is the long-term debt, the long-term borrowings, which has to be repaid after more than 1 year. Plus, we also take into account the minority interest. So here the equity component, it takes into account both the equity as well as the preference shares. Just to give you a simple example, there's the total market value of the debt plus the minority interest. The minority interest are those people who are holding less than 20% stake in the company, right? So those people are the minority interest. You add all of these, and here we get our enterprise value. And that is something which we do not conclude here, and we tend to subtract cash and cash equivalents. We need to subtract cash from the enterprise value, and that is something which we tend to avoid or we tend to forget. So here forward, the major difference between the market value and the enterprise value is the market value just takes into account the total number of shares into the current price of the shares, just the equity and the preference shares component. But if I talk about the enterprise value, it takes into account the equity component, the preference shares component, like within this E parameter, the market value of the debt, that is the long-term borrowings, plus the MI. Here, MI stands for minority interest. Those investors who are holding less than 20% stake in the company, you add and you subtract cash and cash equivalents. Okay. Why do we subtract cash? The main reason to subtract cash is a non-operating asset. Income from EV, right? If we are taking into account equity plus debt plus minority interest, right? The major reason for subtracting cash, the major reason for subtracting cash is cash being a non-operating asset, right? And the second logic, I'll tell you once I try to understand this EBITDA with you. Okay. So whenever the company is going for acquisitions, all the acquisitions are done based upon the enterprise value and not upon the market value. Because the market value of all the firms being in the industry, it will always be less than enterprise value because the market value, it only takes into account the equity shares and the preference shares. It's not taking into account the debt component, which is crucially important, which is very important. So all the acquisitions like which are been done in the market, if you try to understand the M&A profiles, you try to understand financial modeling and valuations, we try to decode EV, the enterprise value for all the acquisitions. And hence the acquisitions price are much more higher because they are being done based upon the enterprise value and not just the market value. Now, again, if you're still with me in the video, please do like, subscribe, and press the bell icon to make me feel motivated to come up with more such interesting and financial videos. So coming back to the session, if I talk about the denominator now, that is your EBITDA. That is your EBITDA. Here, EBITDA stands for earnings before interest, tax, depreciation, and amortization. Interest, earnings before interest, tax, depreciation, and the amortization. EBITDA is also called as the cash profit for the firm. EBITDA is also called as the cash profit for the firm. So now we'll here try to understand that how do we calculate EBITDA? हम EBITDA को like ऐसे calculate करते हैं, and why is EBITDA called as the cash profit for the firm? ठीक है? And here it's important to understand the logic for EBITDA. Correct. So if simply we try to calculate EBIT, so that's your earnings before interest and tax, right? The operating profit of the firm, the simple profit, right? We take into account the total revenue, we take into account the total revenue, and we subtract the total expenses, correct? We subtract the total expenses, and we get something as the company's profit or loss. Correct. If revenues are more than expenses, we make a profit. But if the revenues are less than expenses, we incur a loss. Correct. So here in the expenses component, we are taking into account, the total expenses, all the total expenses which our target company has incurred. But if we talk about EBITDA, in case of EBITDA, we take into account the total revenues, and we subtract all the expenses, excluding depreciation and amortization. We are subtracting all the expenses, excluding depreciation and the amortization. So here I mean we are not subtracting depreciation and the amortization component. Rest, we are subtracting everything from revenue. And once we do it, we get something called as EBITDA, earnings before interest, tax, depreciation, and the amortization. And it is also the reason that why do we call EBITDA as a cash profit? Because we're ignoring depreciation and the amortization in this calculation. Depreciation and amortization being the non-cash expenses. Because whenever a company is incurring depreciation or amortization, the value of the machinery, the value of the plant, the value of the factory, the value of the patent, copyright, right, or tech is coming down, right? Due to excessive usage, like wear and tear, obsolescence, maybe the patent right or the patent permission has got expired. And on result of that, the value of that particular tangible asset or the intangible asset has come down. But the money has not gone out of your pocket till the point of time you incur some expenses for repairs or maintenance or for the patent revival or so. Correct? So money is not going out of your pocket in terms of depreciation and the amortization. Depreciation being charged upon tangible assets and amortization being charged upon intangible assets. So hence we call depreciation and the amortization as non-cash expenses, and that is why EBITDA is also called as a cash profit for the firm, because it is excluding the reduction of the depreciation and the amortization. Now, here we need to understand the second point. So, coming back to EV. Right? So, if we talk about EV, I was telling that cash is a non-operating asset, right? It doesn't generate income for the firm. Cash is cash now. So, cash has come out of the core operating activities. Cash is not generating income for you. Cash is not yielding anything to the core operations, right? Or cash is not trying to maximize the core operations of the business. Cash is a result of the core operations of the business. And that is why we tend to call cash as a non-operating asset, a non-operating activity core asset kind of a stuff. Okay. But the second reason that why do we exclude cash from EV is the basic principle of valuation, consistency. The basic principle of valuation is consistency. It says that if you have a certain parameter in the numerator, a related parameter should be there in denominator only. You cannot have an unrelated parameter in denominator. So for example, if you have an equity multiple in numerator, you must have an equity multiple in denominator as well. If you have an enterprise value multiple in numerator, you need to have an enterprise value multiple in denominator as well. And that is why we have EV to EBITDA. There is no multiple in the market called as price to EBITDA. There is no multiple in the market called as price to EBITDA, because price pertains to market value of equity shares. And EBITDA is something which is available to both equity holders as well as debt holders. EBITDA is something which is a cash profit. It has been generated by the operating activities of the business. Non-cash expenses aren't there. And also that is the reason that when do we calculate EV to EBITDA, to make the numerator consistent with denominator, we tend to subtract cash. We tend to subtract cash because EBITDA is taking into account the cash profit from the operating activities of the business and not from the non-operating activities. The other income is not a part of EBITDA. For all of those who believe that other income is a part of revenue, no. Other income is something which is added after EBITDA. Other income is something which is added after EBITDA. Other income is something which does not arise from the core operation of the business. आपके बिजनेस के कोर ऑपरेशन से अदर इनकम नहीं आ रही है. It's your dividend, it's your gain from investments, it's the interest that you receive if you have invested into some fixed income securities, be it bonds, debentures, the money market instruments per se, X, Y, Z. So other income is not a part of total revenue. It's added after EBITDA. EBITDA is the cash profit, the total profit which the company makes in terms of cash, core activities of the business. And that is the reason to make the numerator consistent, we are subtracting cash from the numerator as well. And that is the formula for EV as well. So here in the numerator, you have an enterprise value multiple, and in denominator also you have an enterprise value multiple, and this gives us EV to EBITDA multiple. Now, so where this multiple is used? This multiple, one thing, it is used in asset heavy businesses. First type of businesses I'm talking about, asset heavy businesses. For those who think it is used only and only in the asset heavy businesses, you are wrong. Because many students, many analysts who are entering into this field as freshers will tend to assume that EV to EBITDA multiple is only being used for asset heavy industries. No, it's also used for asset light businesses. But firstly, coming back to the first type of businesses or the first type of industries, that is the asset heavy industry. So EV to EBITDA is being used for asset heavy industries or cyclical industries, companies having a book value. For example, it can be cement, it can be infrastructure, it can be capital goods, it can be some telecom businesses, it can be defense industries. So heavy metal businesses, the metal companies, oil and gas companies, cyclical businesses, heavy industrial businesses, like which have huge amount of assets with them. And their businesses are dependent upon assets. Their sales, their turnover, their profits are dependent upon assets, good quality assets, like which they have in already. Correct. Again, to judge the quality of the assets, we can see the balance sheet or maybe like try to refer the notes to accounts right in the company's annual report. But that is something that we can try to do later. Correct. So coming back to the topic, EBITDA. Okay, why this EBITDA is being used? Different type of companies, different type of asset heavy companies might have different quantum of fixed assets or tangible assets deployed with them. And hence the amount of depreciation being charged upon those tangible assets might differ a lot. And hence, to compare the companies upon a similar balance, the analysts tend to ignore the depreciation and the amortization component that can make the EV to EBITDA multiple for different companies very volatile. I'll repeat my point. Different asset heavy companies. So, for example, if I take into account Bharti Airtel or a Geo, or if I take into account something from a real estate, right? For example, if I take into account a Lodha developers, right? A Godrej properties, right? Or if I talk about something from a construction, right? GMR, Adani, or maybe I take into account the L&T, correct? So all these companies have different amount of fixed assets, and hence the depreciation charged upon those tangible assets or the fixed assets tend to differ. And hence the EV to EBITDA multiple can become too much fluctuating or very fluctuating and might not give you the true picture of the companies if you compare them holistically. And that is the reason that why this component of depreciation and the amortization is classically ignored to compare the companies upon a similar balance. Secondly, this multiple can also be used for asset light industries because here we have this component of amortization. If you do not have depreciation, if depreciation doesn't work for your industry, amortization might work. Example, IT companies, tech businesses, AI firms, copyrights, patents, because these companies are dependent upon patents, copyrights, trademarks of their brand name, of their tech, of their AI technology, or data centers per se. Correct? So again, this can also be used for IT industries, AI tech businesses, because different businesses have different amount of investments into AI, into tech, into data centers, into GCCs, into new technologies, and hence the amount of amortization being charged upon these intangible assets might differ. And hence, this multiple can also be used for the asset light industries as well. So here we have this EV to EBITDA multiple. And here, if I just need to understand this multiple, if somebody asks you that what this multiple tells you, or if you want to interpret this multiple, again, the interpretation in terms of the valuation remains the same as a price to earning, a price to book, a price to free cash flow. You need to see the average 10-year, 5-year multiple of your particular industry. And if your company trades at a higher EV to EBITDA multiple, you might be overvalued. If you trade at a lower value, you might be undervalued. Or if for example you're trying to gauge the valuation of the L&T, right? L&T is a company, correct? The last sentence too, bro. So if the current valuation is X and the average 10-year valuation has been X plus Y, it means that you are trading at an undervaluation, right? And vice versa is also true. Again, all the companies like which I name in here are just for education purpose. It's not for investment advisory. Always consult your financial advisor to make any kind of investment decision. Okay. So this EV to EBITDA, for example, if this multiple comes out to be 5, right? So it basically tells you for a $1 or 1 rupee worth of EBITDA for a firm, a $1 or 1 rupee worth of EBITDA for a firm, the company has a value of 5 rupees. If my company is able to generate a $1 worth of cash profit, a $1 worth of EBITDA, the value of my company is 5. I'm willing to pay 5 to buy that company 5 times, right? So if I just go to Chrome, and if like for example I just share my screen with you. Again, our favorite website, Screener. So that's the LNT. Again, it's not a stock recommendation. It's just for education purpose. And again, I told you in the price to book value multiple, you can't see a price to earning in these kind of industries, right? Why not? Please refer my YouTube videos for that, right? So here I see I have this EV to EBITDA component with me already. I check the EV to EBITDA, maybe I take it for 5 years. It currently stands at 16.1. The median EV multiple. What's a median? What's an average? How this median EV multiple is different from average EV multiple. I've talked about that in the very first session of the price to earning multiple. Please refer for difference. 15.5. The median has been 16.1. I take a 10-year number. The median has been how much? 14.2. So on a 10-year basis, it's trading at a higher value based upon EV to EBITDA. But based upon a 5-year basis, it's trading at a lower valuation. Now, you might question me, कि sir, आपने तो कहा था कि price to book value use करो for such type of companies. Then how this EV to right like EBITDA has come into place? Now, price to book value is the heart and soul. Again, I will say price to book value is much more important than EV to EBITDA because all such type of companies have their assets and the value depends upon the assets. Correct. But if you want to use a secondary multiple to value such companies, right? If you want to use another multiple, because many analysts, or I would say 99% of the analysts tend to value the company based upon 2 or 3 multiples. Correct. So price to book value being the bread and butter. But after that, the second multiple that you can use if you want to understand or to value the company based upon the cash profit, ignoring depreciation and the amortization, then you can work for EV to EBITDA. Got it? So EV to EBITDA can be used in here. Now, again, the enterprise value can be simply calculated. उसमें आपको ज़्यादा इशू नहीं होना चाहिए. Again, EBITDA can also be simply calculated. So for example, if I go to the P&L, if I just give you a gist of it, तो P&L में अगर मैं आपका एनुअल P&L में जाऊँ, ठीक है, यू हैव द ऑपरेटिंग प्रॉफिट विद यू ऑलरेडी. ठीक है, सो यहाँ पे इफ यू टेक दिस टोटल सेल्स, योर टोटल सेल्स कितनी है? If I take it off for the TTM basis, right? Or if I just take it for a TTM basis में ले लेता हूँ, my total sales are 277,504. ठीक है? My expenses are this much. Correct. So basically, if I ignore my depreciation, so from this 27504, I'll subtract interest, I'll subtract everything, but I will not subtract depreciation. I will not subtract depreciation. Correct? So this is something that will give me my EBITDA. Other income again has to be taken into account separately. It's not a part of EBITDA, right? So basically what will happen if I want to calculate the EBITDA in this scenario? So it's my 277,504, right? Or simply like what can I do is I have the profit after tax like EBIT. EBIT मेरे पास already है, correct? I can simply add back depreciation to ignore its impact. I can simply add back depreciation. So that's your 26,000, 26,027 plus 4259. 26,027 plus 4259 minus this other income, minus this other income. So almost 8,000, 9,000 you are subtracting. Sorry. So you add back, that's a 26 plus almost 4,000 if I take 30,000 minus a 4,000, 4,500. So 24,500 becomes your EBITDA in this case. Correct? Other income is not a part of EBITDA. It's added back separately. Here, just for the sake of showing you and calculating the final EBIT, because see, in EBIT, we are taking into account the other income component. So at the EBIT level, it won't make a difference. Correct? But if you are calculating EBITDA, then other income will make a difference. So one way to calculate EBITDA from this is what? Profit before tax, 26,027. 26,027. You add back depreciation because you want to ignore the impact of depreciation. You add back depreciation because you want to ignore the impact of depreciation, and you subtract the other income because other income is not a part of EBITDA. It's inflating that number. Correct? And that is something that we need to understand ideally. Correct? And again, these values can also be seen from the market screener. So if you go to market screener, you can see that the enterprise value for this company is around this much crores. And if you go to the financials and you go to the income statement in financials, right? So in the income statement, you can clearly see the company's EBITDA level as well, 30,000 crores, right? So if you simply do the enterprise value divided by this value, you should get a number closer to like 16, 17, this number, right? So again, you need not calculate these numbers also because nowadays these numbers are available on the multiple social media platforms. So you have all these values with you already. Okay. So coming back to our Excel file, to share the Excel file. So we have something called as adjusted EBITDA. We have something called as adjusted EBITDA. So what basically happens in case of adjusted EBITDA is, again, it is something which is not defined by US GAAP or IFRS. It is something that we have created. We as company owners or promoters have created that, right? So if you have some kind of extraordinary or exceptional items which is impacting your EBITDA, if you have some kind of extraordinary or exceptional item which are impacting your EBITDA, you can exclude the impact of those items as a one-time adjustment. You can't do it always. So for example, there might be some lawsuit, expenses incurred on lawsuit. Again, a company might not land into lawsuits every year. If a company is landing into lawsuits every year, it means something is wrong. So again, this type of expense can be ignored. So we can add back this to our EBITDA because this is lowering down the value of EBITDA artificially because it's just a one-time it's a kind of one-time adjustment, like one-time exceptional item or one-time extraordinary item. So we can add this back. Some extraordinary gain on loss. You might have disposed of some assets. You might have disposed of some unit of a company which is not working properly, some discarded units, some discarded manufacturing equipment or units. If it's a gain, it's a one-time gain for you. You have to subtract that gain. If it's a loss, it's a one-time loss for you. You have to add back that loss. Again, gain on sale of assets. If it's a gain, just add it back. If it's a loss, just subtract it. If it's a loss, add it back. If it's a gain, subtract it. Unrealized FX loss, gain, or adjustment. Some kind of hedging positions might have been taken upon because the company is dealing into, because the company might be dealing into some kind of exports or imports, and the company will be hedging its currency against the depreciation or the appreciation of the USD, depending upon the export business or the import businesses. So again, if it's a gain for you, just subtract it. If it's a loss for you, add it back. ESOP, it's an expense, add it back. Goodwill impairment is an expense, added back. What exactly do I mean by the goodwill impairment? the value of the goodwill has come down. Goodwill is simply the value that you pay over the fair value of the asset. So, for example, if there is a company A and a company A wants to acquire company B, the fair value of the company B, not the market value, the fair value of the company B, intrinsic value based upon the fundamentals is 100 rupees, right? But if company A acquires the company B at 200 rupees, intrinsic value or the fair value or the fundamental value for company B was just 100 rupees. But company A acquired this for 200 rupees. So 200 minus 100, 100 rupees is the goodwill, and that shall be recorded as a balancing figure in my asset section. But if the value of that company has come down, if the value of the company B has come down, then I might realize that I have overpaid for that investment. Correct? If that 100 value, it comes down to 80. Correct? So that 20 rupees ka difference is my goodwill impairment. My 20 rupees ka difference is my goodwill impairment. I acquired that company at 100 crores extra. 100 was the fair value. I paid 200. 200 minus 100, 100 being the excess value. But now the value of the company has come down by 20 crores. Then I am realizing that I overly paid for that asset. So hence I need to record excess 20, that 20 crores difference as a loss in my P&L. And what do I mean by impairment to be specific? When the carrying value of the business or the asset is more than the market value. What do I mean by carrying value? Carrying value is simply the value of the asset minus the depreciation. So, for example, if the plant has been bought for 100 bucks and the depreciation has been accounted for 20, then 80 becomes my carrying value. Again, many people tend to get confused between carrying value and book value. Carrying value and book value are different. Book value is the total assets minus total liabilities, minus goodwill sometimes, and intangibles also. But your book value is the net worth, broadly total assets minus total liabilities, and that we understood in the price to book value multiple. तो अगर नहीं पता उसको रेफर करो. But carrying value is the book value of the asset minus depreciation. ठीक है, so 80 in this case, 100 is the value of the plant hypothetically, for example, 20 is the depreciation, 80 is your carrying value. Now, if I want to sell off this asset in the market, if I want to sell off the asset in the market rate of that asset is 60 rupees. Then I will need to sell off this asset at a loss. So in this case, 80 is my carrying value and 60 is my market value. 80 is more than 60. 80 is greater than 60 in this case. So whenever the carrying value is more than the market value, it's an impairment. So we tend to do all these kind of one-time adjustments to this EBITDA to make it much more reasonable. And that is something we tend to call it as adjusted EBITDA. So again, the EV multiple can be modified and it can be EV to adjusted EBITDA in some scenarios. Okay, but adjusted EBITDA is something which should not be misappropriately used. It should not be used for manipulation. Why? Because sometimes what happens, whatever expenses which are reducing your EBITDA, right? Sometimes the company tend to add them back always. Or like whatever gains, right? Or like whatever gains, right? The companies are making, which are not as a part of usual course of business, right? They include that as a part of EBITDA, right? So basically, what happens, like many of these startup companies or these new age tech companies or the loss making companies, they need to be profitable first at the EBITDA level and then later at the EBIT level or the PAT level. So as of now, we can recently see that as of the Q3 FY26 numbers, like Blinkit as a part of Eternal has become positive at EBITDA level, not at EBIT level, but at the EBITDA level. Now, here I'm not blaming Eternal, I'm just telling you in general. Sometimes what happens is if you believe that rent, okay, so rent is a part of recurring expense. You have to pay rent for the, I mean to say the type of business or the type of business model your company might be like working within or operating within. You might have to pay rent on a kind of a mandatory basis or a compulsory basis. Correct? So rent can't be ignored. And rent again is not an exceptional item or an extraordinary items per se. Correct. But sometimes what happens if the rent is taking away your profits, if the rent is taking away your EBITDA, sometimes the people tend to use something called as EBITDA R. They will add back the rent expense. That's earnings before interest, tax, depreciation, amortization, and rent. And EBITDA might become a boosted number, an overvalued number, a magnified number. In that case, EBITDA might be misleading. Just to make your company positive at the EBITDA level, you are adding back anything that you want. You're adding back anything that you want. So, for example, if in the future you believe that the raw material price for your company is rising, You might have a word called as EBITDA RRM, EBITDA before interest, tax, depreciation, amortization, rent, and raw material price. It makes no sense. So RM has never been used, but rent has been used by many such corporate. I'm not naming them, but if you find such of the things in the report, just try that whenever you are trying to calculate EBITDA, right? If you have adjusted EBITDA, again the company will not be giving you any calculation for the adjusted EBITDA because EBITDA is not a part of accounting standards. EBITDA is not reported in the annual report. You never get a number called as EBITDA in the annual report. You just get EBIT and PAT. EBITDA is never shown in the annual report also. Even adjusted EBITDA की तो बात ही मत करो फिर उससे आगे. Adjusted EBITDA is something which the company's management, promoters, analysts stock in the market to promote their company, to sell their company. ठीक है? So one thing is you might even not get the breakdown of these expenses in the annual report because adjusted EBITDA is something which is not recognized and they can't show in the annual report. So all these calculations like which have been done or not being done by the analyst, the breakdown of this is something that you will never know. You'll just get a number called as adjusted EBITDA. Or the company might just post in the annual report one single line that are adjusted EBITDA is this much. That's it, and nothing much that. Nothing more than that, ideally. So ideally, you should know how to calculate adjusted EBITDA because if you land into such profiles of analysts, you'll be having some kind of internal information about the company, and based upon that, you guys can calculate adjusted EBITDA because company will give you this data, right? But if a company is misusing this data and including all those rent and all these things, which is magnifying your EBITDA, is something that you have to ignore. Correct? So always pay more weightage to EV to EBITDA rather than EV to adjusted EBITDA. EBITDA R is something which can be superly misleading. So it's all about EV to EBITDA. I am sure that you guys learned something new, especially about the EBITDA and the adjusted EBITDA concept. And again, if you're liking such kind of videos, to subscribe and press the bell icon to make us feel motivated to come up with new such financials and information videos. Thank you so much.